Our guest this evening is Henk Potts. He's an equity strategist at Barclays. He's joining in from London. Henk, many thanks for taking time out for us. We are seeing some solid gains on Wall Street, clearly defying skeptics who've been looking for that May pullback. Do you think equities in America have the strength of moving a lot higher than they already are?
I think the US corporate earnings season has been very positive indeed. In fact, if you look at the results so far, you'll see that earnings growth has come in around about 4% for the first quarter, much better than the 1.5% that analysts were forecasting at the start of the earnings season. So perhaps no real surprise that markets have continued to rally. But alongside that, what we do know is equity markets don't go up in a straight line. There's still the potential, I think, for some of these big macro issues to unnerve investors and reduce risk appetite and cause a pullback in terms of equity markets. But we would certainly say to clients, if that does happen, not a particular surprise, but use any weakness that you tend to see in order to gain exposure to an asset class that's likely to continue to outperform in the medium and long term.
What is your reading on European equities? The DAX is trading at a fresh record high given the troubles in the region. How long do you think the current market rally stroke momentum will last?
Well, there are some significant problems in the Eurozone still to overcome. There's no doubt about that. But alongside that, real progress has been made, as I think we've seen from a greater commitment from politicians and perhaps more notably from the central bank, the European Central Bank under the President of Mario Draghi has done a good job of backstopping the European project, calming market nerves, giving politicians the time to introduce the structural reforms that are required to take us towards that end goal of political, economic and fiscal integration. But that's a project that's going to maybe take a decade to accomplish. In the short term, of course, there will be some potholes along that road to recovery. And we've seen signs of that already, whether it was the bail-in that we saw for Cyprus, the political impasse in Italy over the elections that we've seen there, and worries about fiscal slippage in the likes of Spain. So there's a range of problems, short-term problems that are likely to come along. But actually I think we can rejoice in the fact that the market has been able to overcome these and we continue to move towards that end goal. So long-term to recovery, but we think the progress in Europe will continue, and that should be good news for its stock markets.
Right. And the Chinese trade data has come in much better than expected. Does this allay fears of a slowdown in the Chinese economy?
The growth that we've been seeing from China will continue to be robust over the course of the next few years. We still believe we'll see 7 to 8% growth per annum over the course of the next 5 to 10 years. That's not to say, of course, China doesn't have problems. There are concerns about its housing market. Is there potentially a bubble there that could burst and destabilise the economy? There is a risk of that. They're starting to put in policies to try and deal with that issue. There's worry over the banking system or even the local authorities and the level of borrowing that's come through in terms of those particular issues that will continue to weigh on investors' minds. But we still believe that actually China remains a pretty good investment prospects when it comes to emerging markets, and certainly remains one of our key areas, probably along with the likes of Korea and Taiwan.
And what's your take on emerging markets like, say, India and China? Do you expect to see inflows continue here, given the strength that we are also seeing in developed markets?
Well, we have seen a significant outperformance from developed markets over the course of the past few quarters, led some to suggest that actually we will start to see a rotation from the developed world into emerging markets. I don't necessarily believe that's going to be the case. We would continue to advise investors that the best opportunity still remains in developed markets, given those fundamentals that we were talking about for the underlying growth that we'll see particularly from the United States, but also the bright corporate picture that we've been experiencing with good corporate profitability growth and the ability for companies to continue to flourish within that low interest rate environment. We do tell clients that structurally you, of course, do need to have exposure to emerging markets, particularly in terms of the likes of Asia. It's where a huge percentage of the world's population live. It's where a lot of the growth from the global economy is coming from. But it's worth remembering, of course, emerging markets tend to be smaller. they tend to be less liquid, they tend to be less transparent than their developed market peers, and hence they're seen as riskier. In saying that, of course, you have been rewarded for taking that risk over the course of the past decade or so. And we would still advise clients to have exposure, as I said, to that area. To put it in some sort of context, we would say probably have in a moderate risk portfolio, maybe a 40% of that portfolio should be directed towards developed market equities, whereas for emerging market equities, we'd only have a 10% weighting level. So that puts it in some sort of context.
Hank Potts, always a pleasure. Many thanks for taking time out and speaking with us.